Hey guys, welcome back to the Bitcoin Fortress podcast, episode 199. Today is January 18th, 2026. We are at block height 932,830. Moscow time is 1049 and fees are 1, 1, and 3. This show is for Bitcoiners who want signal over noise, what matters, why it matters, and what it means if you're playing the long game, self-custody, low time preference, and opting out of the fiat circus. So let's get into the news for January 11th through the 18th. We'll start with policy and regulation, the U.S. market structure moment. U.S. senators introduced a long-awaited bill to define crypto market rules. This from Reuters. Why it matters from our perspective, market structure, quote, air quotes, clarity always comes with a price tag. Surveillance, permissioning, and political carve-outs. But it also signals that the U.S. is finally being forced to name the thing and draw lines between the SEC and the CFTC turf. So watch the definitions, digital commodity versus security, language becomes the battlefield. If the bill tries to, quote, protect consumers by forcing everything into custodial rails, Bitcoiners should treat it as a self-custody stress test. And the most important question, does it preserve the right to hold and transact without intermediaries, or does it nudge everyone into KYC wrappers? Senate Banking releases a bipartisan negotiated market structure bill text. This was a Senate Banking press release. And of course, when they publish negotiated text, the lobbying warfare starts immediately and small tweaks become giant outcomes. This is where the manager's amendment stage becomes a magnet for TradFi and exchange influence. Bitcoiners should track this, stablecoin clauses, tokenized equities language, and any, quote, registration requirements that indirectly pressure open source devs. That's what we care about. Coinbase opposes the current form. Senate Banking then delays discussion. This from Reuters. If Coinbase is publicly saying no, the bill is either A, too restrictive for industry rent seekers, or B, a political chess move to rewrite power dynamics. Either way, the sausage making is visible now. Bad legislation is worse than none is a useful line, but Bitcoiners should remember Coinbase incentives do not equal Bitcoiner incentives. If the bill restricts interest or rewards on stablecoins, expect second-order effects across exchanges and fintech products. This is shaping up to be a battle between the banksters and the rent seekers in the crypto world. Moving on to markets and ETF flows, and I guess we could call this institutional mood swings. First up, Bitcoin popped above 97,000 on regulatory optimism. This from Barron's. Price is downstream of narrative. This week's narrative was Washington might finally ship rules. Again, regulatory clarity rallies are fragile. Headlines move faster than reality. Bitcoiners don't need the rally. What they need is sustained adoption and self-custody culture, while Wall Street chases momentum. Spot Bitcoin ETFs posted a big weekly inflow comeback, 1.42 billion, according to Crypto News. Flows are the scoreboard for institutional risk appetite. A strong week after outflows can mark a sentiment turn. ETFs are a funnel. They bring liquidity and legitimacy, but also centralized voting power inside the custodians. You can't vote with your BTC in an ETF. Self-custody is the vote? BlackRock's IBIT scale check. This is from the BlackRock fund page. When the biggest asset manager normalizes Bitcoin exposure at scale, it accelerates adoption and intensifies the cultural split between paper Bitcoin and sovereign Bitcoin. So, IBIT's growth is a marketing engine for Bitcoin, but it also increases the importance of teaching ETFs exposure, not ownership. Moving on to corporate Bitcoin treasury, the Sailor Gravity Well. Strategy buys 13,627 Bitcoin for about $1.25 billion. This from CoinDesk. Like it or not, Strategy has become a giant marginal buyer and a narrative anchor for Bitcoin as Treasury reserve asset. Their behavior is consistent, buy through drawdowns, not just euphoria. But Bitcoiners have to separate two things: Bitcoin the network, neutral, decentralized, and Bitcoin the financialized trade, leverage, premiums, equities correlation. Market read-through, Strategy stock moves with Bitcoin plus premium compression. This article was from Barron's. This is a real-time lesson in leverage and reflexivity. Premiums expand in mania and collapse when the market sobers up. Owning Bitcoin is not the same as owning a Bitcoin proxy. We've talked about this many, many times. If your goal is sovereignty, the cleanest path is still stack sats, withdraw, and keep it in cold storage. Moving along, nation states and public finance. The reserve arms race continues. Florida lawmakers renewed a push for a Bitcoin reserve. This is from Yahoo Finance. State-level Bitcoin reserve talk is political theater and a signal. Bitcoin is entering the strategic asset framing at every layer of government. Even proposals matter. They normalize the idea that Bitcoin is not going away. The Lindy effect. The longer it stays around, the longer it's going to stay around. Ask the key governance question. Who holds the keys? What's the custody model? And can it be quietly rehypothecated? Moving along to mining and network fundamentals. Quiet, brutal, but important. Difficulty dipped slightly in the first 2026 adjustment. This from Yahoo Finance. Difficulty and hash rate are the heartbeat. Slight downshifts can hint at minor stress or shifting economics. Again, a reminder, difficulty adjusts because Bitcoin is anti-fragile. It adapts. We've talked here quite a bit about home mining and decentralization of mining. It isn't about ROI, it's about resilience. So if you don't already have one or two or three, buy a BitX, plug it in, see if you can win the lottery. You never know, but for a few dollars a month of electricity, you can help strengthen the network. That is my pitch for home mining. Minor stress signal, small difficulty drop may hide deeper profitability pressure. This one from CryptoSlate. Mining is becoming more capital intensive. Cheap power is increasingly contested. That pushes consolidation pressure, which Bitcoiners should counter culturally with education and small-scale participation where possible. Again, plug in a BitX. Have some fun at home. Hash price pressure squeezes the weaker operators that operate at scale, and the long-run bullish case, though, is that stress shakes out the tourists, committed operators remain. Mining is a tough, tough business to be in. All right, moving right along. Next up, we will talk about security, scams, and the human attack surface. 282 million stolen via a social engineering hardware wallet attack. This is from CoinDesk. The weakest link is still the human being. This is the perfect story to reinforce OPSEC. Verify everything. Slow down and assume you are a target at all times. This was not a protocol failure, it was a confidence game. Oldest trick in the book. So, some practical reminders. Never share your screens with strangers. Don't install, quote, helpful tools, and separate your devices for signing versus browsing. Be resilient, be smart, have strong OPSEC, keep your coins safe. Next, Chainalysis record estimated 17 billion stolen in scams and fraud in 2025. Impersonation plus AI acceleration. Again, this was from Chainalysis. As Bitcoin adoption grows, scams industrialize. AI makes it cheaper to convincingly impersonate. Bitcoiners have to treat security education as part of adoption. And again, remember, they're not hacking systems, they're hacking people. Self-custody without self-discipline, folks, is a liability. All right, moving right along. We will now talk about the narrative war, quantum FUD, and model portfolios. We've talked quite a bit in the past about quantum FUD, and there's some new ones this week. A new one, not a new one, an old one, but a new voice. Jeffrey's strategist drops Bitcoin from long-term portfolio, citing quantum risk. This was from the Business Insider. Quantum gets used as an existential talking point whenever Bitcoin momentum returns. It's worth addressing calmly. The risk is real in theory, distant in timeline, and solvable via upgrades, while fiat systems have present-day guaranteed debasement. Again, quantum is a technology risk, not a Bitcoin-only risk. Banks, state cryptography rely on similar primitives, and if it's a problem for Bitcoin, it's a problem for everyone, and everything is going to have to harden against the quantum threat at the appropriate time. But the real takeaway here is Bitcoin is not set and forget. It's a living open source system with an upgrade path. But of course, that upgrade depends upon consensus, which is tough to get. But slow change is better than no change. All right, moving right along. Here, let's take a look at the Bitcoin podcast themes of the week. First theme, regulatory clarity, is the new liquidity narrative. Expect lots of pundits framing this as bullish for price, while Bitcoiners focus on, does it preserve self-custody and permissionless usage? Taking a look at Investopedia Express, discussing ETF activity and macro context. Again, links in the show notes to all this. Theme 2, macro framing is back. Rates, liquidity, election cycle policy. Of course, this year's the midterms in the United States, and so there's a lot of people talking about money printer go burr, Bitcoin pump. We shall see. 2026 Outlook content is everywhere. What matters is whether people understand Bitcoin as a response to monetary policy and not a tech stock. Third theme, security education is becoming inseparable from adoption. Big ticket social engineering losses, AI impersonation are forcing creators to hammer the basics again. And finally, the fourth theme, the state reserve meme, is spreading. Even when bills are symbolic, the Overton window is moving. Bitcoin is being discussed as a treasury asset, not a toy. Few podcasts that cover these themes this week. The Bitcoin Standard podcast, the episode published on January 13th, macro fiat inflation discussion format that definitely fits this week's vibe. Citadel Dispatch had a fresh mid-January 2026 episode cycle. Freedom Tech open source, counterweight to the TradFi narratives. Always enjoy hearing about that. And finally, what Bitcoin did. The episode feed includes a 2026 macro outlook, good reference point for what is circulating out in the zeitgeist. Next up, we'll talk a little bit about the featured Bitcoin Substack post of the week, why the system needs you distracted. The system doesn't need you broke, it needs you busy, reactive, and short-term. Distraction is not entertainment, it's governance. The more distracted you are, the easier it is to inflate your savings away, sell you convenience over sovereignty, and keep you outsourcing your responsibility. Bitcoin rewards the opposite personality: patience, clarity, self-responsibility, long time preference. Self-custody is an act of focus. It forces you to slow down, learn, verify, and opt out of someone else will handle it. If they can't control your money directly, they'll try to control your attention, because attention is where decisions are born. Link in the show notes. Check it out. Also, subscribe. It's free. Quick reminder, if you want to go deeper, check out my 3 books, which are available on Amazon in all formats: Bitcoin Fortress, A Simple Guide for Beginners; Bitcoin Retirement and Estate Planning, especially relevant now with the new year and new tax rules, which I do discuss fairly extensively in that, and The Bitcoin Lifestyle. If you've read them, thank you. If you haven't, that's your next step. Also, please leave a review. That helps a lot. Well, folks, that about wraps it up for episode 199. If you got value from this, please share it with one person who needs more signal and less noise in their life. Stay humble, stack sats, and I will see y'all next week. Bye-bye.